The best is yet to come in the stock market. O lo mejor está por venir en la bolsa. Atentos a la entrevista en exclusiva que traigo aquí en el canal, el que para mí es uno de los mejores analistas de Wall Street, si no el mejor analista de Estados Unidos. ¿Hacia dónde se dirige la economía en 2026? ¿Cómo están los mercados? ¿Por qué hay un potencial que puede ser enorme por delante? ¿Y en qué fase del ciclo nos encontramos? ¿Qué es lo que ve Ryan Detrick, el analista de Carson Research, para este entorno actual? ¿Dónde están los riesgos? Pero sobre todo, ¿dónde está ese gran potencial? Todo eso es lo que vamos a ver a continuación. Antes te voy a decir una cosa muy importante. Hemos hecho un trabajo de subtitulación y de doblaje de esta entrevista. Podéis ver los subtítulos en castellano, pero también en YouTube tenéis la posibilidad de poner el audio en castellano. Así que deja ahí tu me gusta. Lo voy a repetir después en inglés en la entrevista, como vas a comprobar. Pero deja tu me gusta, tu comentario y suscríbete al canal para apoyar este tipo de contenido que es muy exclusivo y muy difícil de conseguir. Así que eso como recordatorio y empezamos. Hi everyone and welcome to my channel. It is an honor to me to welcome one of the best analysts in the US, in my opinion, in the United States, Ryan Detrick. This is his third time here in my channel, and I'm delighted to hear his opinion on the economy and on the stock market. So welcome again, Ryan. It is a pleasure to me to having you here again.
I guess third time's a charm, apparently.
Yeah.
No, but Hector, thank you for having me back. I know you have a newborn, so you're going on fumes a little bit, but I'm excited to talk about it. And I mean, you said in the United States, why not the world? Aren't I one of the better analysts in the world? I'm just teasing. I don't know.
One of the best for me, but that's me, my opinion. Yeah. So before we begin, I would like to ask the audience to like the channel, leave a comment and subscribe. And that said, I'd like to start with your view on the economy, Ryan. You recently posted on X that your LAI indicators continue to show that US economy is out of the danger. Do we have a clear path to 2026?
Yeah, we think we do. You know, I know I've, like we said, been with you a couple times. Carson Group, we're a large RIA in the United States. We have about $54 billion. I work with financial advisors all over the United States. And we've been we took the road less traveled this time, 3 years ago. Everybody is talking about a recession in 2023. We said no. We've been pretty optimistic ever since. And it wasn't always popular. And a lot of people didn't like that because it went against the crowd that was told there had to be a recession. Unfortunately, it hasn't. But you look at 2026. We just a week ago released our mid-year outlook. We titled it Riding the Wave. And we think there's a lot of waves that are out there. But on the economic side, we have fiscal policy. We have monetary policy. We have strong earnings, and we have AI, and I'll just gently touch on each of them. AI, we'll start maybe going reverse here. I mean, the AI spending is not slowing down, right? There's a lot of CapEx that's coming. In the United States, CapEx has been a decent chunk of GDP, and that's not slowing down anywhere anytime soon. You have very strong earnings. You have strong profit margins. We call those the dual tailwinds to a bull market and a strong economy. We think that's the case. Then, on the fiscal side of things, there's a lot of people in the United States that are going to be getting a lot more money back in their taxes very, very soon. The One Big Beautiful Bill, there's certain things that are honestly front loaded, if you will. So some of the more benefits are early, which is this year. So, I mean, it is a midterm year here in the United States. There's a lot of politics involved in this, but trying to get people in a good mood, give them maybe a little bit more money on the fiscal side of things should probably be a positive. The monetary policy, last thing, put a bow on top, that's the Fed, right? The Fed has cut interest rates 3 times last year. They've cut 1.75% the last couple of years as inflation's come back. But I'll just put it this way. An old saying, Hector, don't fight the Fed. The last 22 times the Fed cut interest rates with the stock market near an all-time high, 1 year later, the market was higher 22 times. And they did that 3 times last quarter. So put it all together, there's still a lot of momentum to this economy. We think the economy is improving. And globally, we're seeing actually strength from various LEIs, leading economic indicators, internal proprietary ones we have, that show the rest of the globe is starting to improve, which is only going to be a positive. We think, at least specifically for the U.S. And the globe in general, it's a good thing to see. A lot of waves out there that are tailwinds.
So now the narrative are changing in stock markets. So for some analysts are saying us that we are in some of kind of a bubble in the AI space. Why do you think they are wrong, or why do you think they are talking about this narrative right now in all time hikes? Nasdaq is in all time hikes. S&P 500 also. What's your point of view in that sense?
No, great point. I mean, just this week, Business Week has a cover with the bubble on it, right? I mean, we are seeing and hearing a lot about this. One thing that's interesting is tech pricey? Yes. Technology, if you look at the 11 sectors in the S&P 500, technology is pricey. Technology actually is one of the few groups last year, 2025, that actually got cheaper from the start of the year to the end of the year. So the earnings justified in our view. Now, you could say there are pockets of technology that got ahead of itself. Some of those big IPOs we had, some of the more, the crypto IPOs we had. I mean, those really, quantum computing. I mean, those stocks went up a lot and they've come down a lot. So you could say some of the air was let out, maybe a bubble to a degree right there, but it's not the late 90s. In our opinion, this bull market's justified by earnings. The tech names, of course, if you remember or looked at your history books, you slap .com on something in late 90s, the stock would go up a couple 100%, and then we all know what happened later. Majority of those companies went away because they weren't making any money. That is not what we're seeing now. But I mean, listen, if someone's worried about priciness in the market, technology, tech adjacent things like communication services, yeah, that's pricey. You know what's not? Small caps, mid caps, industrials, financials. I mentioned in my first answer, we think around the globe. I mean, the U.S. is up 18%. How'd the rest of the world do, right? I mean, literally the rest of the globe was up like over 30%, okay? All around emerging markets, all around Europe, developed international. We don't think that's over. We think there's still a lot of juice left because, again, I'm a U.S.-centric investor, obviously. I know your listeners are all around the globe. But in the U.S., the attitude for a while was, gee whiz, why don't I just own 7 stocks? Why don't I just own the Mag 7? Why am I ever investing in any of this other stuff? And then last year happened, and it showed why you should have a globally diversified portfolio, why you should look at other areas that potentially can do well. And we think, last comment, the lifeblood of a bull market is rotation. We're encouraged by this rotation that we've been seeing. Tech had a big down day last Thursday, yet every other sector was higher. That to me, that's a good thing. You know what? You asked me a question. I just went on a rant. I'll actually answer your question here. It took me a while to get there. The S&P 500 last year was up 18%. If you look at where that came from, you can break it down by sales and margins and margin expansion and multiple expansion. 14% of that 18% gain came from earnings. Another 1.5% came from dividends. So the rest came from multiple expansion. Yes, that's not much. Again, you look at the last 6 years, S&P 500 is up 132%, right? Like 100% of that, even a little bit over 100%, came from earnings and sales and dividends. So yeah, there's some multiple expansion in there, but it's nothing like what we saw in the late 90s. And again, we just don't think it's a bubble. But if you really think tech is a bubble or there's a big bubble out there, you could own things like gold, you could own bonds, you can own other things that have a diversified portfolio, but we manage a lot of money. We still think stocks are going to do better than bonds this year. It's still a global bull market. So those are the areas that that's how we see things shaking out in 2026 so far.
So definitely the 2026 is a year for rotation. Energy is cheap than if you look at the past, is a good multiples. Also healthcare sectors, there are sectors that are cheaper than before. So you think this is a year for rotation?
We do. And some of those names you just mentioned, like value, right? I mean, what's done well, at least in the U.S.? I mean, it's growth. We get it. The last 3 years, where's most of the economic growth, earnings growth come from? Well, growth. That's where it's come from. But earnings growth in technology is actually year over year kind of decreased a little bit. It's still strong. I'm not minimizing it. But what's been increasing the last couple of years? Value earnings. All right. Those some of the areas you just mentioned. I mean, cyclicals, cyclical value, financials, industrials. This economy is almost broadening out. So to us, yes, it makes sense to look at some other things versus the shiny object of just Mag 7. I mean, interesting stat again on bubbles, kind of combining the question you asked me a second ago. There's 7 stocks in the Mag 7. Only 2 of them outperformed the S&P 500 last year. So that means 5 of them didn't, if my math is right. And the reality, again, is that's not good. That's not bad. It's whatever it is. My take is it's positive because the S&P 500 is still hitting all-time highs. I know we're down a little bit time we're doing this today, but I mean, we've had a heck of a start. One thing I think is kind of cool, hopefully listeners like this, the first 5 days of the year, okay, in the S&P 500, if it's positive, right? So first off, let's go this route. Any one random year is up 72% of the time, about 9.5%. That's any one random year. When you're up the first 5 days, that goes up to like 80% and 16%, okay? But when you're up more than 1% the first 5 days, Hector, like we were this year, those numbers get even better. And no, you should never blindly invest in just 5 days on how the year starts. But I think when you stack it on top of just so many other things that we've been talking about, there's a lot of tailwinds that still say this bull market's live and well. And let's just be very clear, after the rally we've had, after a 7-month win streak last year and a virtually flat December, January will be shocked if January's up a little bit, but just know the first quarter has been weak. And think the last couple of years, we have a major peak, not a major, but we have a peak in February, weakness into the spring months. I mean, who knows how this is going to shake out? But I think what we really try to stress, especially this time of year, start of the year.
Yeah, in that sense, I see a post in your X account. You said that we don't see a Santa rally this year, but there is no problem with that, because if you take the other years that we've not seen a Santa rally, this kind of environment that we have right now, we finally see a end year rally. So 2026, maybe we are in the same stage that these other years, right?
That's right. So again, the Santa Claus rally is the last 5 days of the year and then first 2 of the following year. And those are like the strongest 7 days of the year. I mean, it is what it is. Now, 3 years in a row now, we've not had a Santa Claus rally. Now, this year we were down 0.11%, so not down that much, but still negative. The last 2 years, how did things go? Pretty good. Now, listen, in 2000, in 2008, there was no Santa Claus rally. Even in 2016, people probably forget this if you haven't been around long enough. 10 years ago, the first 5 or 6 weeks was like one of the worst starts to year ever back in 2016 when we didn't have Santa Claus. We didn't have Santa last year. How did the first 4 months go? Not all that great when you look back. Now, that's because of the tariffs and Liberation Day. But, maybe there's a near-term warning, but then you look bigger picture. If Santa Claus doesn't come, but the first 5 days are positive and the month of January is positive, which I know January's not over yet, halfway through it, looking like we probably will be, at least as of now. That's usually more of a tailwind for investors to be fairly optimistic, which obviously, as I've already laid out, we still are.
And talking about your risk that you are monitoring, what is the biggest risk to the markets today? Economic, financial, geopolitical, that is not properly priced, maybe. Why do you think investors are ignoring it? Or what is your analysis in that sense? What is the main risk for you?
Sure. I mean, there's always risk. And what happens so many times, I've done this a long time, it's usually something nobody saw coming. I mean, truly, no one thought Liberation Day was going to have the stock market go down 20%. I mean, I don't know, maybe somebody did, but I didn't hear too many people saying that. So who knows? But I mean, you clearly have potential issues with Iran, U.S., the Middle East. I mean, that's always out there. Could something happen with China and Taiwan? I don't think so, but I sure hope not. I mean, that absolutely could upset the apple cart. I think what's one that we're kind of eyeballing that we can kind of control, if you will, at least be aware of, is the Fed. I mean, it's the Fed. Could there be a potential policy mistake? We have a new Fed chairperson coming in May, right? And historically, when you have a new Fed chairperson, take a while, guess what happens? Yields go higher, market goes down. The market tends to test that new Fed chairperson. We are of the camp that the Fed, probably going to cut a couple more times this year. We're glad they cut a couple times last year. But I mean, listen, the next Fed chairperson, it's very clear what their goal is or their instructions are, right? It's coming from President Trump. He wants lower interest rates. I mean, that's very, very clear. Now, it doesn't mean the Fed has to do it, but I mean, geez, there's going to be a lot of pressure to cut some rates if you're the next Fed chairperson, if the president picks you. Now, you got to go through Congress and different things, but that's the way it's going to be. But if we start to see inflation heat up a little bit, which the good news is we're not. I mean, we just got more inflation data in the U.S. We're not seeing that yet. But if inflation starts to heat up and the Fed continues to cut, I want to be very clear, for this year, that's usually a positive. I mean, when you have a little bit higher inflation with the Fed cutting, that's usually net positive for assets. But eventually, you're going to have to pay the piper. And that could be trouble. Now, let's not forget, this is a midterm year, right, in the U.S. here. And historically, midterm years are the most volatile. Actually, they're one of the weakest. They have the largest peak-to-trough correction. I wouldn't blindly invest just because of that, but that's out there as well. But at the end of the day, I think geopolitical concerns, which you can't control and are always out there, is there. But at the same time, I think Fed policy is one. But the truth, again, the consumer's pretty solid. All right. I mean, retail sales today came in pretty solid, right? We continue to see a labor market that's low hire, but low fire. So if you have a job, you're doing pretty good. Real wages could be a little bit higher, but we just saw a really strong productivity number in the U.S. I mean, the way last thing on this, way I usually answer this is, what's the biggest risk? I've been saying this for a couple of years now. It's people listen to all the negative stuff out there. People don't realize we are in a major secular bull market that's global. Maybe the biggest risk is investors miss a lot of this rally, because I get to work with financial advisors and clients every single day, and trust me, I hear it all the time. Like, well, I heard a year ago that Trump was going to crash everything and the market's going to go down, so I sold. Or I heard AI is in a bubble. Or I heard it's regional bank crisis 23. Or the yen carry trade unwind, so I sold everything. Yeah, I mean, there's always worry and concern. Every year is going to have that stuff. We're not blind to it. I mean, we're overweight equities. Yes, we have some bonds. We've had gold for 3 years now, Hector. When we bought gold 3 years ago, people thought we were crazy. Now it's like, yeah, that's worked out pretty good. So have a diversified portfolio. Have some things that help you sleep at night. But again, I'm not a swing trader. I'm not a short-term trader. By no means am I a day trader. I'm an investor. But I think for investors looking out this full year, there's going to be 10% correction probably at some point during the year. Just get ready for that. Plans are useless. Planning is everything. President Eisenhower planned for that. And if that should happen, don't panic. Stick with your plan and maybe even add and buy some solid global companies on the cheap is how we see it here.
So as an investor, as you mentioned right now, in which moment of the cycle do you think we are right now?
Boy, that's a good one. Because, I mean, I can give you examples like consumer confidence in the U.S. is literally like as low as it's ever been. That says your early cycle, because usually people are feeling a little bit better as the economies grow. I mean, our economy, we just had a 4.9% productivity number and a 4.3% GDP number in the third quarter, yet everybody feels terrible. I don't get that, but that's just what the data says. That's the soft data. But then there's other parts that say we're more, potentially late cycle. I'm not seeing that. I guess to answer your question, I'd say we're more mid-cycle. I mean, the Fed is still cutting. They're not hiking it. Usually hike near the end of these cycles. These things can change. Anything can happen. But, I put it this way. There's cycles and bull markets. Equity guys, so I'll talk about bull markets just for a second. This bull market just had its third birthday back in October. The S&P 500 bottom October 22, just in third year. So it's in its fourth year. The fourth year bull market is usually pretty strong, Hector. In fact, the last 50 years, when a bull market got to this point, only 5 of them. The average length was 8 years. The shortest was 5 years. And you had 2 that were like double digits. We're not calling for that. But I think the key concept is this bull market is probably younger than most people think. And age is just a number. And the truth is, again, this bull market probably has a little bit more life.
As I told you before we record the interview, I was in New York City early December. And I talked with some strategists there, and they told me the same as you, or the scenario is pretty good for this year, and maybe we have the highway with no cars, and we have a great year ahead. They told me that one indicator that they are focused, if we see some problems, is the IPOs in the Wall Street, and we are now in no overheating IPOs in Wall Street. So you are agree with that? This is an indicator that you're monitoring if you see the overheating stock market?
Yeah, great point there. Because SpaceX is widely expected to have a very large IPO, and there's a lot more. I mean, you can look it up. There's a lot of big names that people use and know that are looking to have IPOs this year. And people have short-term memories. And in 2021, we saw a lot of SPACs. We saw a lot of IPOs. A lot of people made a lot of money. People were trading and getting money from the government and just having a great time. And then in 22, vicious bear market, and bonds had their worst year since George Washington was the president of the United States. So that is a potential contrarian warning to see some IPOs. Doesn't mean it has to peak, but I'll tell you, we talked about AI a second ago. When you look at the cover of Time magazine, the person of the year was all the tech leaders, Jensen and everybody. There's like 7 or 8 of them listed on there. So that got me. And then you've got Jensen listed as the Financial Times Man of the Year, or maybe it's called Person of the Year, as well. So there's a lot of excitement toward AI, which I don't think is shocking. A lot of people made a lot of money in that part. But again, that's maybe why that part of the market maybe doesn't lead. I'm not saying it's going to lag, but I'm saying it doesn't lead. And then you just mentioned some of these big IPOs as a potential contrarian warning. That's something we are watching. But I'll tell you, at the end of the day, what I like to really watch are the credit markets, like credit spreads, triple B spreads, and investment grade spreads, and corporates and things like that. I've been saying this for 3 years now. I'm still saying it. The credit markets are not saying there's a monster under the bed. If the IPOs are a true warning sign, if the yen carry trade was a true warning sign, if all this other stuff's a warning sign, like we're keeping promised on TV, I think we'd see more stress in the credit markets. And Hector, the good news is we're not. We watch this stuff every single day. The other thing I like to look at market technicals, advanced decline lines, how many stocks going up versus down. I mean, those just a week ago hit all-time highs. Usually those peak about 9 months before price. So breadth leads price. If you have breadth strong and your credit market's calm, end of the day, those are two things I'm going to follow, and I get all the worries and concerns. And that's why we're not 100% equities or all in leverage equities. We have other parts of our portfolios in case we're wrong on our fairly optimistic views here. And even just being globally diversified. I mean, the aughts, the 2000s, U.S. market did terrible. It was like the worst decade ever, worse than the 30s. How did emerging markets do? How'd gold do? How did international do? How'd small caps do? Spoiler alert, they did pretty well, all things considered. And again, that's why you should have a diversified portfolio in case our optimistic view is wrong. But we're still we feel pretty good that it's still going to be a pretty good year for investors in 12 months.
Just to make you a last one, which is related with precious metals. Precious metals, gold, silver, copper are exploding, or maybe were exploding last year. This year also, we are in the same stage. So are you positive with metals?
We are, and I mean, so many different ways to look at this. We added gold to our short-term tactical or shorter-term tactical models with real money that we manage on it was a March 31st, 2003, right after the regional bank crisis. I was one of the very few people that I know was out there saying, listen, we're about to hit a period for years where gold and stocks go higher together. Everybody thinks gold and stocks cannot go the same way until you look at history. And there's periods of 6 and 7 years where gold and stocks go higher together. Well, we're 3 years into this with both going higher. I think they're both going to continue to go higher, but in the very, very near term, if someone hasn't owned any gold or silver to just go in all right now, I would advise probably not, because silver is about as extended as any asset I've ever seen. I mean, it's had an incredible run. This time next year, I think silver is still higher than where it is right now. I think gold is still higher than it is right now. These base metals and these precious metals, a lot of them have been in bull markets just for like a couple of years. Go back again, everyone, look at history. These bull markets last a lot longer than you think. So it makes sense to have some of that in a well-diversified portfolio. But again, they're very stretched. What gets me, gold did its thing, and now it's like a lot of other ones are catching up. I mean, silver is trying to catch up in a hurry. In fact, it might have passed it. But you look at things like copper, which is just now breaking out to new highs, kind of like gold was this time 2 years ago. Gold broke out to new highs in early 2024. All right, how'd the last 2 years treat gold after the breakout? So I think a lot of these base metals are things that have lagged a little bit. Honestly, crude oil is the other one. Right? Crude oil's obviously been lower, and there's a lot of reasons for that. I wouldn't be shocked at all if crude oil played catch up this year and worked its way a little bit higher to catch up with these other metals. But all in all, if you drop it and it hits your foot and it hurts, that's something we've jokingly said for a while. You probably want to have some of that in your portfolio, and clearly that has worked out really well the last couple of years.
So Ryan, thank you very much to be with me here in my channel. It has been a pleasure, and also I ask to the audience to follow you in your X account, in your socials. So thank you very much again for chatting with me.
Hector, I appreciate it. Thank you for that. Yeah, I'm out there, so you can find me, and look forward to doing this again. I wish everyone a happy and safe 2026. And hopefully this bull market keeps going. And Hector, hopefully you get some sleep with that newborn. But thank you again for having me back.
Thank you. I hope so. Thank you so much, Ryan. Thank you.